Bitcoin's next collapse was just triggered, but not by whales. And what's unfolding right now is far more dangerous than anything retail investors have seen in the last 4 years, because the signal that fired this time didn't come from on-chain metrics, didn't come from whale wallets, and didn't come from panic selling. It came from a silent macro shift so powerful that it forced the biggest institutional players to reposition instantly without waiting for confirmation. And whenever that happens, Bitcoin always becomes collateral damage long before the charts show it. What most people don't realize is that major crashes do not begin with giant red candles. They begin with liquidity evaporation, a slow and invisible thinning of demand that retail never detects until price collapses violently. And that exact process has already started, even though the market still looks calm on the surface. The most shocking part is that the trigger behind this move wasn't emotional, wasn't news-driven, and wasn't manipulation from whales. It was a mechanical response to a surge in global yields, a sudden tightening in funding conditions, and a rapid withdrawal of risk appetite from institutions that have been holding the market up for months. This withdrawal created what analysts call a liquidity vacuum, and once that vacuum forms, the market behaves like a room with the oxygen removed. Price doesn't fall because someone pushes it. It falls because there's nothing left to support it. What happened over the last 72 hours is exactly that. A rapid, silent disappearance of institutional bid support, the same pattern that appeared right before the May 2021 crash, when Bitcoin collapsed from $59,000 to $30,000, the same pattern that showed up ahead of the November 2022 FTX meltdown, and the same pattern that triggered the March 2020 bloodbath. And now it has returned with even greater intensity, because this time the liquidity engines that normally stabilize the market are themselves under pressure. Retail investors still believe the market is stable because the price hasn't moved dramatically, but institutions aren't watching price. They're watching volatility measures, debt yield correlations, cross-asset liquidity flows, ETF inflow stagnation, and risk exposure constraints, and all of these flipped simultaneously this week, which is something that almost never happens unless a major downward event is coming. And the most terrifying truth is that this collapse isn't being triggered by someone selling Bitcoin. It's being triggered by institutions losing the ability to buy Bitcoin. When money dries up at the top levels of the financial system, every risk asset suffers, and Bitcoin, being one of the highest volatility assets, suffers first and hardest. This is why smart money quietly stepped aside while retail continued celebrating small green candles. They know that when the liquidity trigger fires, the chart always reacts late. What's unfolding now is the beginning stage of a mechanical unwind, a phase where institutional algorithms automatically reduce exposure regardless of market sentiment, forcing a chain reaction that pulls demand out of the market faster than price can adjust. This stage is invisible to retail traders because the candles look normal, the RSI looks neutral, and the sentiment on social media still feels optimistic. But deep underneath, the structural support that keeps Bitcoin stable is dissolving. It starts with thin order books, then spreads to widening spreads on institutional desks, then flows into reduced ETF net inflows, and finally ends with volatility spikes that force automated hedging across multiple funds. This is the exact blueprint that has preceded every major crash, and this week all 4 phases began simultaneously. That is why analysts are warning that the collapse is not something that might happen, it is something that has already been triggered, and we are now watching the early symptoms of a much larger move. The scariest part is that most investors will not know what hit them until the price suddenly drops thousands of dollars in a single day, because liquidity-driven crashes don't give warnings. They break silently, then explode all at once. Right now, Bitcoin is standing on top of a hollow floor, a floor that used to be supported by deep institutional liquidity. And that floor is cracking faster than anyone expected. And the truth is simple. This collapse wasn't started by whales dumping. It was triggered by the system itself. And when systems break, no whale in the world can save the market from what comes next. Asterisk, what happens next is the phase that destroys the most retail investors, because after the liquidity vacuum forms, the market enters what institutions call the displacement window, a period where price still looks stable enough to fool inexperienced traders into thinking the worst is over, even though the underlying system has already begun its mechanical unwind. This is the moment when people buy the dip thinking it's a simple correction, unaware that the demand which used to absorb volatility has disappeared, and every small drop now pushes the market closer to an abrupt cascade. The displacement window is always quiet. It was quiet before the May 2021 crash, quiet before the FTX implosion, quiet before the China ban collapse, and quiet before every major flush in Bitcoin's history. And it is quiet right now to an almost frightening degree. What makes this moment uniquely dangerous is that the pressure isn't coming from crypto-specific events. It's coming from cross-market contagion, where tightening conditions in traditional markets force institutions to raise cash instantly. And the easiest place for them to pull liquidity from is high-volatility assets like Bitcoin. The problem is that these institutions don't scale out slowly. Their models trigger, and they exit in bulk, leaving behind a vacuum that amplifies every downward move. At the same time, retail traders misread this silence as consolidation and start buying aggressively, unknowingly catching falling knives because the system they depend on for support is no longer functional. Right now, Bitcoin is showing the classic signature of this phase: volume drying, candles shrinking, volatility compressing, and order books thinning at the top levels of the market. These signals don't look alarming to the average trader, but to institutions, they scream one thing: incoming expansion. And expansion after compression, when liquidity is gone, is almost always downward. Another factor feeding the collapse is ETF stagnation, something retail almost never pays attention to. Over the past weeks, inflows slowed dramatically despite relatively stable price action, which indicates one of the clearest institutional warnings possible: big players aren't buying the bounce. This tells us two things. First, they expect more downside, and second, they are preparing capital for cheaper entries. But before cheaper entries appear, the market must go through a cleansing phase where leverage is wiped out and weak hands are flushed. This cleansing is not optional. It is a structural requirement created by liquidity math. And once the liquidity engine shuts down, the flush becomes automatic. At the same time, derivatives data is showing a surge in open interest but a decline in actual spot buying, creating an imbalance that always resolves violently because it means traders are using borrowed money to chase a market that no longer has real demand behind it. When this imbalance reaches critical mass, liquidations begin. And when liquidations begin in a low liquidity environment, price can crash faster than any human can react. We are already seeing the early signs: funding rates flipping neutral to negative, spot 2 futures divergence widening, and stablecoin flows slowing on major exchanges. These indicators combined reveal one truth: smart money is not supporting the current price zone. And when smart money steps away, Bitcoin becomes extremely sensitive to even small triggers. The craziest part is that retail still believes whales are responsible for every drop, but whales are not the threat here. Whales can move price. They cannot destroy the market. The only entity capable of collapsing Bitcoin is the system itself. And right now that system is weakening from every angle. Liquidity from Asia sessions is thinning. US session depth is falling to multi-month lows. European flow has turned risk, and cross-asset correlations are spiking, meaning Bitcoin is being treated as a liquidity source instead of a growth asset. When Bitcoin becomes a liquidity source, institutions sell it not because they want to, but because they must. And forced selling always leads to bigger breakdowns than intentional selling. The most disturbing signal came from volatility models this week, which were recalibrated across multiple funds, automatically increasing hedging requirements. When hedging increases, long exposure decreases, and when long exposure decreases, liquidity thins even further. At the same time, retail influencers continue promising the breakout is coming, unaware that the mechanics behind the market are already breaking down. Bitcoin is now in a position where one sharp move can trigger a cascade of liquidations, pulling the entire market down with it. And the worst part is that the catalyst for that sharp move doesn't need to be large. In a thin market, even a moderate sell order can create a chain reaction. We are entering the critical window where markets fall not because of fear but because of mathematics. And when math takes over, sentiment becomes irrelevant. Bitcoin is approaching a point where every uptick is artificial and every downtick is structural. And when markets reach that point, collapse becomes a matter of when, not if. This is the final phase, the stage where the collapse stops being invisible and finally shows itself on the chart. And this is when retail panic begins, because the first real red candle always arrives without warning, hitting the market harder than anyone expects. And by the time people realize what's happening, the system has already fully committed to the downside. During this stage, institutional liquidity doesn't just step back, it actively accelerates the fall through automated risk reduction, which forces long positions to unwind across ETFs, funds, and leveraged products at the same time. This is why crashes always feel sudden, even though the warning signs existed long before the first big candle appeared. Right now the signals are pointing to that exact moment approaching. Volatility is expanding from an artificially compressed state. Stablecoins are moving into exchanges not for buying but for pre-positioned sell orders, and order book depth around key support levels has thinned to levels where even a moderate sell block can trigger a cascade. The dangerous part is that this collapse won't start at the obvious levels. It will begin slightly above them, where liquidity pockets are weakest, tricking retail traders into thinking it's just a healthy pullback. But this isn't a pullback, and it isn't a correction. It's a structural unwind driven by the absence of institutional support. The first drop will trigger a second drop as stop-loss clusters are hit. The second drop will trigger leveraged liquidations. Those liquidations will widen spreads, and the widened spreads will force market makers to hedge aggressively, which accelerates the collapse further. It's a chain reaction that can't be slowed once it begins, because each phase feeds the next. At the same time, retail behavior becomes extremely predictable. They try to buy the dip, hoping for a bounce that won't come because the liquidity needed to support that bounce no longer exists. Institutions know this, which is why they don't rush in early. They wait until the complete flush is over because they want maximum risk removed before stepping back in. This is the part where social media becomes a pool of denial, with influencers telling people to stay calm while the market silently prepares its largest downward expansion since the last major cycle collapse. And while everyone is distracted, a far more important shift is happening. Bitcoin's correlation with risk assets is strengthening, which means any volatility in global markets now amplifies through Bitcoin at a much higher rate than before. This amplification is what turns a normal dip into a full-blown crash, because if traditional markets fall at the same time, Bitcoin loses its last lifeline, a chance of external capital stepping in. When this correlation spikes, Bitcoin is no longer trading on its own fundamentals. It's trading as a liquidity sponge, absorbing the shockwaves of every global move. That's exactly what happened in March 2020, in May 2021, and in November 2022. And the pattern is repeating once again. What makes this collapse even more inevitable is the positioning of institutional algorithms, which are currently skewed toward defensive mode. Defensive algorithms don't buy dips, they preserve capital. And when the biggest liquidity providers go defensive, the entire market becomes fragile, creating the perfect conditions for a waterfall event. The collapse will not look gradual. It will come in waves, sharp drops followed by weak bounces, each bounce smaller than the last because the buyers stepping in are too small to counter the selling pressure from the system. Eventually the market reaches its breakpoint, the level where leverage is fully flushed and the majority of retail capitulates, selling at the exact bottom institutions wanted. This is the point where the system resets, where liquidity finally stabilizes, and where the collapse ends not because sentiment improves but because there's nothing left to liquidate. And when the dust settles, institutions return with fresh liquidity, buying aggressively at levels retail traders were too terrified to touch. This is how every major cycle resets, and this cycle is no different. Bitcoin's next collapse was triggered not by whales but by the silent machinery of the financial system. And once that machinery activates, there's no reversing it. The collapse will run its course, as it always does. Not controlled by fear or manipulation, but by the mathematics of liquidity and the mechanics of risk. And when Bitcoin eventually finds its bottom, the same people who denied the warning signs will pretend they saw it coming, while the ones who understood the deeper structure will already be preparing for the next move long before the market recovers. Asterisk.